If you've been tracking cryptocurrency markets lately, you've probably noticed something's fundamentally off. The optimistic narrative from late 2025 head-on has called it some brutal market realities in early 26, and what we're witnessing is just another correction. It's a complete repricing of what crypto actually represents in portfolios and what role it plays in a deteriorating economic environment. Let me walk you through what's actually happening using verified data and on-chain metrics, not speculation of social media hype. This isn't about fear-mongering or trying to get you to panic sell. It's about understanding the forces shaping crypto markets right now so you can make informed decisions with your hard-earned money.
Bitcoin recently experienced one of its most dramatic sell-offs in history, and the speed of the decline caught even seasoned traders completely off guard. The cryptocurrency crashed from over $126,000 in October 2025 to briefly touching $60,000 as of $62 on February 5th, 2026. That's a total drawdown of nearly 40% from its all-time high in just 4 months. The week ending February 5 saw Bitcoin drop almost 30% in 7 days alone, which is the kind of move that destroys portfolios and wipes out years of gains for over-leveraged traders. As of today, February 9th, Bitcoin trades around $75,000 to $92,000, depending on the exchange and time of day, still down roughly 22% to 27% year over year. This wasn't a gradual decline where you could see it coming and adjust positions. It was a cascade of forced selling that fed on itself, creating exactly the kind of liquidity vacuum that makes markets dangerous. On February 5th and 6th, crypto markets experienced what Charles Schwab's institutional trading desk called a full liquidation event, and that term carries specific meaning in derivatives markets. Over $542 billion in leveraged positions have been wiped out since January 29th. To put that in perspective, that's more capital destroyed than some small country's entire GDP. February 5th alone saw $256 billion in liquidations, making it the 10th largest single-day liquidation event ever recorded in crypto history. Funding rates went deeply negative as long positions got systematically destroyed, and when funding goes negative, it means shorts are paying longs, which only happens when markets are in complete panic mode. Implied volatility spiked above 90, and for those unfamiliar with options pricing, volatility above 90 indicates extreme market stress, where options traders are pricing in massive potential moves in either direction. What does this mean in plain English? Traders who borrowed money to buy Bitcoin, whether through traditional margin or through Bitcoin-backed loans, got margin calls they couldn't meet. When you can't meet a margin call, your position gets liquidated automatically. You don't get to choose the price or timing. They were forced to sell, pushing prices lower, which triggered more margin calls for the next tier of leveraged traders, creating what's known as a liquidation cascade or death spiral. Charles Schwab's institutional desk noted something absolutely crucial that most retail traders miss. Retail investors using Bitcoin-backed loans got liquidated and wiped out, while large institutions had enough capital reserves to meet margin requirements without selling their underlying Bitcoin holdings. Translation, retail got absolutely crushed again, while big money stayed solvent and likely accumulated cheaper Bitcoin during the panic. Bitcoin bounced sharply on February 6, surging back above $70,000 with an 11% single-day gain, and social media immediately filled with calls that the bottom was in and it was time to buy aggressively. But context matters enormously here. This came after a 15% plunge the day before. Percentage-wise, you need bigger gains to recover from losses. If you drop 15%, you need a 17.6% gain just to break even, not 15%. The rebound doesn't change the fact that Bitcoin remains nearly 40% below its October peak, and that kind of drawdown destroys the narrative that Bitcoin is a stable store of value or digital gold. Prediction markets on Polymarket, which aggregate real money bets on future outcomes, suggest a 54% probability that Bitcoin ends February around $75,000. That's barely better than a coin flip, which tells you how uncertain the market actually is, despite confident predictions you see on social media. Downside scenarios of $60,000 or lower still carry a 42% probability according to market pricing, meaning nearly half of market participants who are putting real money behind their views think we could retest or break the recent lows. When Bitcoin spot ETFs launched in January 2024, they were marketed as the gateway for institutional capital flooding into crypto, the moment when Wall Street would finally embrace digital assets and drive prices sustainably higher. For a while throughout 2024 and into early 2025, that narrative worked beautifully. Billions flowed into Bitcoin ETFs every month. BlackRock's IBIT became one of the most successful ETF launches in history. Not anymore. Recent ETF data through early February 2026 tells a completely different story. Net outflows of approximately $32 million year to date might not sound catastrophic until you realize that during the same period last year, we saw billions in inflows. November through December 2025 saw record withdrawals of $457 billion, the worst 2-month stretch ever recorded for crypto ETFs. This isn't noise in the data. This is a structural shift in institutional positioning. January 30th saw nearly $1 billion in outflows from Bitcoin and Ethereum ETFs combined in a single day. And when you see billion-dollar outflow days, it indicates large institutional players are exiting positions, not retail investors moving $5,000 accounts around. On February 5th, during the worst of the sell-off, $544.9 million was withdrawn in a single session. BlackRock's IBIT, which had been the poster child for institutional Bitcoin adoption, led the exodus with $373.44 million in outflows. Fidelity's FBTC followed with $86.44 million. These aren't minor players or obscure funds. These are the two largest asset managers in the world pulling capital out of Bitcoin. Compare that to the same period last year when Bitcoin ETFs collectively purchased 46,000 Bitcoin, and the reversal becomes stark. Now they're net sellers, actively removing Bitcoin from their holdings and returning cash to investors. CryptoQuant, a leading on-chain analytics firm, published analysis identifying this shift clearly. Institutional demand has reversed materially. Several factors explain this reversal, and understanding them is critical to understanding where we go from here. Bitcoin broke below its 365-day moving average for the first time since March 2022, which was right before the Terra Luna collapse that triggered the last crypto winter. Technical traders pay close attention to these multi-month moving averages because they represent the average price at which holders bought over the past year. When price breaks below that level, it means the average holder is now underwater, which psychologically shifts sentiment from greed to fear. Since that breakdown, Bitcoin has declined 23% in just 83 days. Deutsche Bank analyst Marion Labor published research observing that traditional investors are losing interest, and overall pessimism about crypto is growing, not just among retail, but among the institutional allocators who were supposed to provide steady bid support. Bitcoin hasn't behaved as digital gold, which was one of its core investment theses. It's moved in lockstep with technology stocks, particularly the NASDAQ, undermining the hedge narrative that convinced many investors to allocate in the first place. When you market something as uncorrelated to traditional markets and it ends up with a 0.8 correlation to tech stocks, investors feel misled and exit positions. Bitcoin's adoption as a form of payment for goods and services has been minimal despite a decade and a half of existence. You still can't buy groceries with Bitcoin at most stores. You can't pay your mortgage with Bitcoin. The payments use case, which was the original white paper vision, has largely failed to materialize at scale. Even when Bitcoin ETFs see occasional inflow days like the 562 million on February 2nd that got celebrated across crypto media, they're immediately followed by renewed selling that wipes out those gains. The February 3 outflow of $272 million erased nearly half of the previous day's inflows in less than 24 hours. This pattern of short-lived rallies followed by renewed selling is characteristic of bear markets, not bull markets. In bull markets, dips get bought aggressively and sustain. In bear markets, rallies get sold. We're clearly in the latter environment. Total assets under management in crypto ETFs have fallen from over $140 billion in late 2025 to around $100 billion now. That's a $40 billion haircut in institutional capital in just a few months. When you lose nearly 30% of assets under management that quickly, it indicates something structurally changed in how institutions view the asset class. The crypto sell-off isn't happening in a vacuum, and this is where the analysis gets more interesting and more concerning. The U.S. economy is showing significant stress across multiple indicators, and this matters enormously for crypto markets because they're predominantly driven by retail speculation and discretionary investment. When people are worried about keeping their jobs and paying their bills, they don't have spare capital to invest in highly speculative assets like cryptocurrency. The December 2025 unemployment rate hit 4.4%, which was the highest level since October 2021. That might not sound catastrophic, but the direction and velocity matter. We went from 3.5% to 4.4% in less than a year, which represents a massive deterioration in labor market conditions. Long-term unemployed workers, defined as those out of work for 27 weeks or more, increased by 397,000 over the year. These aren't people between jobs for a few weeks. These are people who've been searching for work for more than half a year and haven't found it, which indicates structural problems in the economy, not just temporary friction. Initial jobless claims, which measure how many people filed for unemployment benefits for the first time, jumped to 231,000 in the last week of January. That's sharply above market expectations of 212,000. And when labor market data consistently misses expectations on the negative side, it suggests the economy is deteriorating faster than economists anticipated. Job market confidence is collapsing in ways that don't fully show up in the headline unemployment rate. The New York Federal Reserve conducts regular surveys asking workers about their perceived probability of finding a job if they lost their current one. That probability fell by 4.2 percentage points to 43.1%, reaching a new series low since they started tracking this metric. This decline was driven primarily by respondents with annual household incomes below $100,000, which is exactly the demographic that historically drives retail crypto speculation. The quits rate, which measures how many workers voluntarily leave their jobs, remains lower than pre-COVID levels. In strong labor markets, workers quit freely because they're confident they can find better opportunities elsewhere. In weak labor markets, workers stay in jobs they don't like because they're afraid they won't find anything better. Current quits rates indicate decreased confidence in the labor market, which reinforces the point about deteriorating conditions. According to JP Morgan's economic analysis published in January, unemployment is expected to peak at 4.5% sometime in 2026, which means we likely haven't seen the worst yet. The first half of 2026 will likely deliver uncomfortably slow growth in the labor market, creating an environment where job creation barely keeps pace with labor force growth. Here's the connection that matters for crypto and that many analysts miss. Retail investors don't have spare capital to invest in speculative assets when job security is declining and wage growth is stagnant. The crypto market has historically relied heavily on retail speculation to drive price action during bull markets. Institutional money provides a base and reduces volatility, but the explosive moves that take Bitcoin from $20,000 to $60,000 in a year come from retail FOMO. When everyday investors are worried about keeping their jobs, when they're stretching paychecks to cover rent and groceries, when they see their friends getting laid off, they're not opening Coinbase accounts and buying Bitcoin. They're cutting discretionary spending and building emergency funds. That fundamental shift in household financial behavior creates a massive headwind for crypto prices that no amount of institutional accumulation can overcome in the short term. Credit card debt has reached absolutely staggering levels that indicate households are under severe financial stress. Total outstanding credit card balances in the United States hit $1.25 trillion as of late 2025, according to Federal Reserve data. To give you perspective on how dramatic this is, that's nearly double the $660 billion in credit card debt that existed in 2013, just 12 years ago. This isn't modest growth in line with population and inflation. This is parabolic acceleration in household borrowing to maintain consumption. What makes this particularly concerning is that credit card debt is the most expensive form of consumer borrowing. The average APR on credit cards accruing interest is above 22% as of Q4 2025. When households carry balances at these interest rates, a huge portion of their monthly payment goes to interest rather than principal, creating a debt trap that's extremely difficult to escape. After the pandemic, households drew down the excess savings they accumulated during stimulus periods. Simultaneously, living costs for non-discretionary expenses like rent, food, and insurance rose dramatically. This created a scissors effect where savings declined while expenses increased, forcing households to rely on credit cards to cover everyday expenses, not just discretionary purchases or emergencies. Surveys and Federal Reserve research indicate a growing share of credit card debt is being used to pay for groceries, utilities, and basic necessities rather than vacations or luxury items. When families need to borrow on credit cards just to buy food, that's a sign of severe economic distress, not temporary cash flow management. According to Bankrate research published in early 2026, 47% of American credit card holders carry a balance as of December 2025. That's basically flat since November 2024, but dramatically up from 39% in December 2021. Nearly half of cardholders are paying interest every month, which means nearly half are unable or unwilling to pay off their cards in full. Perhaps most concerning, about 61% of cardholders with credit card balances have been in debt for at least a year, up from 53% in late 2024. This includes 31% who have been in debt for at least 3 years and 21% who have been in debt for at least 5 years. This is chronic debt, not temporary borrowing. Among credit card debtors surveyed, 41% say their debt comes primarily from emergency or unexpected expenses, including medical bills, car repairs, and home repairs. But 33%, up from 28% in 2024 and 26% in 2023, cite day-to-day expenses such as groceries, childcare, and utilities as their primary source of card debt. Here's the brutal math for crypto. When household credit card debt is at record highs, interest rates on that debt are above 20%, real wages aren't keeping pace with inflation, and job security is declining, retail investors simply don't have the discretionary capital to drive speculative rallies in crypto markets. They're financially tapped out. The few hundred or few $1,000s a month they might have invested into Bitcoin or altcoins in 2020 and 2021 is now going toward minimum credit card payments and increased costs for rent and food. This creates a fundamental demand problem for crypto that can't be solved by better marketing or new ETF products. The retail investor base is financially exhausted. Market analyst Yuya Hasegawa from BitBank noted that the recent Bitcoin sell-off appears to have been driven by a combination of rising geopolitical risk, a decline in tech equities triggered by disappointing earnings from Microsoft, and a breakdown in precious metals prices. But there's a deeper structural issue at play. Mike Willis, CEO of Cyber Hornet ETFs, explained the ownership divide clearly. You really have two types of Bitcoin ownership. The OGs, the original holders who bought Bitcoin years ago at prices below $10,000, are hodlers who have religious conviction and never sell regardless of price. However, the newer buyers, the institutional investors, and retail participants who view Bitcoin more as a new technology investment are far more swayed by market pullbacks. They treat it like a risk asset, like a tech stock, and when risk assets sell off, they sell their Bitcoin too. This creates structural volatility in the market. Original Bitcoin believers hold regardless of price, providing a floor of demand, but they're not enough to drive prices higher by themselves because they're already fully invested. Meanwhile, newer institutional and retail investors treat Bitcoin like a high beta technology stock and sell during downturns, creating the sharp sell-offs we've seen. The market needs the second group to drive prices higher, but that same group sells aggressively when conditions deteriorate, creating the boom-bust volatility that scares away the very institutional capital the market needs for sustainable growth. Interestingly, not all crypto assets are equally affected by the current sell-off, and the divergence in performance tells you something important about where capital is rotating. Recent ETF data shows Bitcoin ETFs experiencing heavy sustained outflows, with $272 million leaving on February 3rd alone. Ethereum ETFs show mixed results but are generally weak, with some days showing modest inflows of $14 million, immediately followed by days with $79 million outflows. XRP ETFs have been surprisingly resilient with $19.46 million in inflows on February 3rd, potentially reflecting anticipation around regulatory clarity and institutional adoption for cross-border payments. Solana ETFs saw modest inflows of $1.24 million, which is minimal, but at least not seeing the massive outflows affecting Bitcoin and Ethereum. This pattern suggests selective rotation within crypto rather than wholesale exit from the asset class entirely. Investors and institutions are differentiating between crypto assets based on perceived use cases, regulatory positioning, and technological development rather than treating all crypto as an undifferentiated speculative asset class. That's actually a sign of market maturation, even though it's happening during a painful price correction. In previous bear markets, everything sold off together. Now we're seeing more nuanced capital allocation, which could be healthy long-term, even if it's uncomfortable short-term. Let's be absolutely direct and honest about what Bitcoin was supposed to be versus what it actually is, because the gap between promise and reality is driving a lot of the current repricing. The original investment pitch positioned Bitcoin as a hedge against inflation. That narrative drove enormous capital inflows in 2020 and 2021 when inflation fears were rising. But that thesis failed. Bitcoin crashed during 2022 when inflation was actually running hot at 8% to 9%. If it were truly an inflation hedge, it should have rallied during that period. Instead, it dropped over 70%. The pitch also marketed Bitcoin as digital gold, a safe haven asset you could flee to during market turmoil. That failed too. Bitcoin correlates heavily with technology stocks, with correlation coefficients often exceeding 0.7 or 0.8. When NASDAQ drops, Bitcoin drops. That's the opposite of a safe haven. It was also supposed to be an alternative to fiat currency for payments. Virtually nobody uses it for payments in practice. Finally, it was marketed as a store of value that would preserve wealth over time. It's down 40% in 4 months from peak to trough. That's not storing value, that's destroying it. What Bitcoin actually is becomes clearer when you strip away the marketing narratives. It's a speculative technology asset with high volatility that attracts traders looking for outsized returns. It's a leveraged bet on risk-on market sentiment. It's a vehicle for institutional trading strategies. And it's an emerging asset class that's still trying to find its purpose 15 years after creation. None of this means Bitcoin has no future or will go to zero. What it means is the narrative has fundamentally shifted from the promises made in 2020 and 2021, and markets are repricing accordingly based on what Bitcoin actually does rather than what people hoped it would become. Despite Trump administration promises of crypto-friendly policies, concrete regulatory framework remains frustratingly elusive, and this regulatory uncertainty continues to weigh heavily on institutional participation. Ongoing uncertainty around lawmakers' efforts to create legislative guardrails makes compliance officers at major banks extremely cautious. Clear stablecoin regulation hasn't materialized despite multiple bills being introduced. Institutional custodianship rules remain fuzzy. Tax treatment clarity is still lacking. Until these fundamental regulatory questions are resolved with actual legislation, institutional capital will remain cautious. Where do things go from here? The bearish scenarios paint a legitimately grim picture. 10x Research estimates Bitcoin could drop to $50,000 after a potential small bounce. Michael Burry warned of a potential death spiral with no organic use case reason for Bitcoin to slow its descent. Some analysts point to $40,000 to $50,000 as a potential bottoming range if current support fails. The bullish scenarios still exist and offer hope. February has historically been a bullish month for Bitcoin with historical average returns of 14.3%. If Bitcoin reclaims $90,000 decisively, technical structure suggests targets of $98,000. Federal Reserve rate cuts expected in 2026 could provide tailwinds for risk assets. Halving-driven supply dynamics may eventually reassert themselves. The most likely scenario involves continued range-bound trading between $70,000 and $90,000 through February, with periodic volatility spikes. Selective institutional buying will likely occur on significant dips below $70,000. Retail participation will remain weak until the job market stabilizes. Gradual recovery requires broader macro conditions to improve. Key technical levels include support at $72,000, $70,000, and $60,000 to $65,000 if current levels fail. Resistance zones include $80,000, $86,000 to $90,000, and $100,000 as major psychological barriers. For retail investors, the reality check needs to be brutally honest. If you're investing money you need in the next 6 to 12 months, crypto is extremely risky right now. The combination of economic uncertainty, institutional selling pressure, high leverage, and correlation with risk assets creates an environment where further 20% to 30% drawdowns are possible. If you're still accumulating, dollar cost averaging into quality assets makes more sense than lump sum buying. Avoid leverage entirely. Understand that 2026 may be a year of consolidation, not explosive growth. Only invest what you can afford to lose without affecting your life. For institutional allocators, the calculus has changed substantially. Bitcoin ETFs provide convenient exposure, but recent outflows show conviction is fragile. Correlation with tech stocks undermines diversification arguments. Regulatory clarity remains a prerequisite for larger allocations. Crypto exposure should be sized as high-risk satellite position, not core holding. For long-term believers, current weakness could represent opportunity to accumulate at prices that will look cheap in 5 years. But distinguish between buying the dip and catching a falling knife. Accumulation makes sense in tranches over time. Infrastructure development continues regardless of price. Time horizon matters. Think in years, not months. The crypto market correction is a symptom of larger shifts. We're seeing the end of easy money. The stimulus-driven bull run exhausted itself. Institutional reality has set in. Large players trade tactically, not buy and hold forever. There's a use case gap. Promised applications haven't materialized at scale. As recession risks rise, speculative assets get sold first. The crypto industry needs to change its approach. Stop over-promising, build real utility, accept regulation, reduce leverage. Excessive borrowing creates volatility that scares away serious capital. Where does this leave us in February 2026? Bitcoin and crypto markets are under pressure. Institutional flows have reversed. Economic headwinds are reducing retail participation. Leverage remains a vulnerability. Regulatory clarity is pending. What we don't know is whether current support will hold, when institutional buying will resume, how long consolidation will last, or whether promised regulation will materialize. The responsible approach requires acknowledging uncertainty, size positions appropriately, diversify broadly, stay informed using data, not hype, think long-term. The crypto market isn't dead, it's repricing. That process is painful but necessary for building sustainable value. Whether you're accumulating, holding, or exiting, do it with eyes open to risks and potential. The market doesn't care about your entry price or conviction. It cares about supply, demand, and capital flows. Right now, those flows are telling us something. Listen to what the markets are saying rather than what you wish they were saying. That's how you survive bear markets and position for the next bull market whenever it arrives. This analysis is for informational purposes only and should not be considered financial advice. Cryptocurrency markets are highly volatile and speculative. Always conduct your own research and consult with a qualified financial advisor before making investment decisions.